Hi, my name is Lydia O'Leary. I'm a franchise consultant with FranChoice, and thank you so much for joining today. I also have my own brand, Omvia Franchise Consulting. So what I do and what Eric Wexler here also does, who's on the call, we help people transform their lives through franchise ownership. And we do that by getting to know them, getting to know their goals, their backgrounds, their skill set, their investment level, and we match them to one of the 200 or a couple of the 200 plus franchises that are in our inventory that are pre-screened at FranChoice. Now, what's great is our service is at no cost to people because we're actually paid by the franchisor, similar to how an executive recruiter is paid, because we help them find qualified people who are a good match for their brand, which leads to a good chance of success. Now, a question I get asked all the time is, how can people afford a franchise? And I get asked, because my husband and I are franchise owners ourselves, is how did you afford it at such a young age? And so we thought, Eric and I thought it'd be helpful to have Michael Reeder on, who's an expert in the finance industry. And we'll tell you a little bit more about his background in a bit, to talk about different funding options, different strategies, and different entity structures to really help set people up for success. So Eric, if you wouldn't mind introducing yourself, and we'll go from there.
Thanks, Lydia. As Lydia said, Eric Wexler have been helping people through the diligence process of determining whether a franchise business model was the right fit for them or not to achieve their goals. I've been doing it for a couple of decades now, about 23 years, and it's very fulfilling to help people through the process. Franchising is a brilliant way to do business for those for whom it's right, and a very practical consideration is how to fund the business, whether or not you can afford it, and ultimately how to fund it. So we certainly support a whole lot more than just that, but that is a very practical, very important component.
Thank you. And we are going to let Michael Reeder take it from here. So Michael Reeder and I met a couple of years ago. He is actually our CPA and has done a fantastic job. And he is actually known in the franchise industry to help small businesses and franchise owners themselves with different funding options and make sure that they're set up for success. So we are very thankful for him, and I'm excited for him to educate you about the different options out there so you can see maybe this is the right path for you. So Michael, I'll let you go ahead and introduce yourself.
Thank you, Lydia. Thank you, Eric. And it's great to be with you all today. My name is Michael Reeder. I'm a CPA, and I'm the owner of Reeder CPA Group. We're a virtual national accounting and tax practice, and we have a niche working with franchise businesses. So just a quick background on me. So I'm 38 years old. I own the CPA firm that hired me out of college. I'm originally from Chicago. And I've been, as you can see on the slides, we're recording this webinar right now. It's August 2025. So as of August 2025, I've been a CPA in public practice for about 14 and a half years. And over the last approximate 11 years and some change, I've developed a niche as a CPA working with franchise businesses. And it's a pretty cool story how it started out, because I was a junior partner at the time of the firm that I now own outright in the Chicago suburbs at the time, and we acquired a little book of business in the Chicago area, and I'm doing the taxes for one of the new clients that we just acquired in said book of business, and I'm doing his S corp tax return, and his business is a franchise consultant. So this has to be 2014 or 2015, and I'm doing his taxes. And I have have a few questions. Hey, what's this? What's that? And say, hey, what's a franchise consultant? And he told me what he does. And so this is the first time that I learned what a franchise consultant was. And so once I learned, how he connects prospective franchisees to prospective franchisors, when he makes a placement, franchisor pays a commission, like Lydia said, similar to an employment recruiter. I told him, I said, hey, that's pretty interesting. Hey, if any of your candidates have any questions about entity structure strategy, funding strategy, tax strategy for small business ownership, I'd be happy to talk to them for free. Just dive into these topics with them. And that's all. And if they want to work together with me in a paid context once they're in business, great. If not, great. And so he took me up on my offer. It proved to be a triple win, right? It was a win for the candidate because he or she got, valuable advice during this crucial phase of their franchise buying process. It was a win for the consultant because it just made their team look stronger, their consultancy look stronger, more value add to the with their client slash candidate. And it was a win for me because I got the opportunity to provide value to a prospective, client, future client of my CPA firm. And so did it. It proved concept. He started to refer his candidates routinely, and then I just leaned into that. Ever since then, I just started networking with other franchise consultants across the country, primarily on LinkedIn. And so here we are about, 11 years later, and I'm doing the exact same thing at scale. I have a nationwide network of franchise consultants such as Lydia and Eric that I work with. We also have relationships with franchisors that we work with in a similar context. And Reeder CPA Group is built for the franchisee business, and we add value to the franchise consultant and the franchisor by being a CPA resource for their prospective franchisees in the context that I described.
Wonderful. Thank you, Michael. And a great story, and it's cool to see it come full circle. So let's talk about what you typically talk about with prospective franchisees, which is the different buckets and the foundation, and going into some more detail there.
Absolutely. So as we have on the slide here, the foundation, right? 3 buckets that shape funding and entity strategy. So like I said, I've been doing this process of talking with franchise candidates via their franchise consultant or franchisor, meeting them during their franchise buying process. And the thing that we talk about on the free CPA consultation call is entity structure strategy and funding strategy, coming at those 2 things from the angle of strategic tax planning. Entity structure, right? Should I be an LLC, S Corp, C Corp, sole proprietorship, et cetera, et cetera? Funding, should I do SBA loan, Rob C Corporation, HELOC, 401k participant loan, et cetera, et cetera. So this process I've been doing, like I said, for, this is not something that I just, started doing like a couple months ago and just like freestyling it. This is a process that I fine-tuned and optimized over the last decade plus. And so one cannot have a substantive conversation about entity structure and funding without first getting context on 3 buckets, right? So whoever I talk to, no matter what franchise they're looking at, no matter what, I always, like, before I start advising on entity structure and funding strategy, I first get context on 3 buckets. Bucket 1, what is your investment going to be initial plus the first 12 months? Bucket 2, what are your assets, right? And then within that, I'm looking for cash, other liquidity, retirement, and real estate, right? Bucket number 3, what's your household income and expense situation looking like? Once I have those 3 things on a piece of paper, and now we have an intake form that people can fill out, so we have a lot of that stuff coming into the consultation. Then, me and my team can advise on, hey, I think that you should structure your entity this way, and here's why, right? Hey, I think that you should fund your business this way, and here's why. The why behind everything is crucial, and we approach those 2 things from the angle of strategic tax planning. So, the 3 buckets is the foundation of entity structure and funding strategy, because you can't do the latter without the former.
Absolutely. So there's a lot of different options out there. And I think we have a couple slides actually, Michael, so maybe we'll stick to the SBA ROBs and conventional loans. So can you talk through some examples why someone would go for an SBA loan versus a ROBs, or do sometimes people go and do combinations? Of course, the first thing that Eric and I always talk about, and I'm sure you know too, Michael, is it's so important that they find the right match for the franchise that they're looking at: skill set, experience, investment level, goals, all the above. But then once they find that match, they need to have a funding strategy in place to make sure that they're set up for success. So what are some of the options? Can you go into some more detail?
Yeah, absolutely. And I have to control myself because I get passionate about this topic, and I can legit go for 3 hours. The most common funding topics are SBA loans and ROBs. What is ROBs? Right? ROBS is an acronym for rollover as business startup. It's a way for you to use your retirement assets to fund your business. But it has to be structured as a C corporation, because it's essentially a way, it's a workaround the self-directed IRA. So a lot of people out there may be familiar with a self-directed IRA. And a self-directed IRA allows you to invest in non-conventional investments, such as real estate, crypto, precious metals, et cetera, that you may not otherwise be able to invest in a regular IRA or a regular 401k. And so Rob's rollover as business startup, what it is it's a unique structure. So we're going to go into Rob's here a little bit, and then we'll go into SBA. So Rob's is a structure that first you have to be set up as a C corporation, right? So you work with a Rob's company. There's some great ones out there. You work with a Rob's company, and they set up your C corporation. And setting up a C corporation itself is not that big of a deal. Like that's something that, any CPA or lawyer or LegalZoom can do. But the niche thing about a Rob C Corp is not so much the filing the articles of incorporation and getting the tax ID number with the IRS. It's once the C corporation is set up, then the Rob's vendor is going to set up a retirement plan for the C corporation. And it's that retirement plan document that is the value add and why you work with the Rob's vendor to set up the Rob C Corp, because the retirement plan for the C Corp, the retirement plan document is going to be worded in a certain way that's going to allow for the investment in privately held stock. And that's the difference between a self-directed IRA and a Rob's C Corp, is that because a Rob's retirement plan is an ERISA plan, it allows for the investment in privately held stock, whereas a self-directed IRA does not. And so you set up a C corporation, and then retirement plan is set up for C corporation, right? And then once you do that, then you take your existing retirement funds. They might be sitting in an old 401k or an old IRA, and you roll it into the new Rob C Corp retirement plan, right? And then the retirement plan invests in the stock of the C corporation. So step one of the money flow, once the Rob's is set up, then the step one of the money flow is the tax and penalty free rollover, going from old retirement account to new retirement account, right? Rollover from one retirement account to another. That's just a rollover, no taxable event there. Once the money is in the C corporation retirement plan, then the C Corp retirement plan invests in the stock of the C Corp. That's step two of the money flow. That's called the capitalization of the business. And that's how the money finds its way in the C Corp checking account, where it can be used for the investment and operations of the business. And so that's how a Rob C Corp works in terms of how it's created and how it's funded. And then a big thing from an accounting and tax perspective that you have to be aware of if you go this route is that you're structured as a C corporation. And the majority of most of the time, the majority, if not all of the stock is owned by the retirement plan itself, right? So if Eric Wexler does a Rob's, then chances are Eric Wexler, the individual with his social security number, is not the shareholder. It's Eric Wexler's retirement plan for the benefit of Eric Wexler, the individual, is the shareholder. So it's just some nuances there. All the Rob's companies have great compliance departments that can help through with the retirement compliance aspect of a Rob's. And then it's a C Corp. And so when you're taxed as a C corporation, there are certain nuances that you have to be aware of. If you want to take money out, you're able to reimburse yourself. You're able to reimburse yourself for any business expenses paid from personal funds at the beginning. So if during the whole Rob setup, if you incurred, $30,000, $40,000, $50,000 of startup expenses, startup marketing, travel, if you, paid a portion of the franchise fee out of personal funds because the Rob's wasn't capitalized yet, once the Rob's is capitalized, and you can reimburse yourself for business expenses paid from personal funds. And then from there, if you were to pay yourself personally, then you would have to take a salary. And so there is more like some in the weeds stuff with Rob's that I won't go into right now, just to because I have to constantly remind myself, Mike, not everyone's a CPA out there. But that's high level how a Rob's works. And then there are certain ERISA retirement plan compliance rules that make a Rob's different than a regular C corporation. And so I do think that, maybe something for another day, Lydia, Eric, and myself, we can legitimately do a whole webinar just on Rob's. It's that deep. So that's a Rob's. And so now if you have a startup loss in a C corporation, it doesn't flow through to the personal return. So if you have a $100,000 loss in the startup of your business, then it's not going to offset, it's not going to flow through to and get reported on your personal tax return and offset your or your spouse's W-2 income, for example. It's going to stay in the C corporation and it's going to roll forward as a net operating loss carry forward, where it will offset subsequent year C corp taxable income. So that, and then exit planning in a ROBS, again, you have to go about it. You have to plan for it, with a CPA like myself and my team and some other ROBS, ERISA attorneys on staff at the ROBS vendors, or there's some great ROBS attorneys out there. But exit planning in a ROBS has to be navigated carefully, again, because the majority, if not the entire shareholder, is the retirement plan. So proceeds from sale more are going to go back into the retirement plan. So that's what ROBS is, right? And so now SBA is the most common form of leverage strategy, right? And so leverage, there's SBA, there's also what I've been doing a lot recently with the emergence of AI is I've made it like a 10 to 12 minute video of just showing people how to do a detailed ChatGPT conversational research on how to search for municipal, county, state, federal, nonprofit loans and grants that are out there, in addition to SBA. So those things that I just mentioned, plus SBA, are the most common forms of third-party debt. So what's interesting about why I'm a big SBA, like why SBA is really a great option for franchise startups, is because it's much easier. The SBA has a franchise directory that there has to be about like 7,000 plus franchisors on it that are approved for SBA lending, right? And so if you're a startup business, right? Like if Lydia starts, for example, like if Lydia starts Lydia's dog training business, and that's it. It's just an independent business and it has no history. It's going to be much harder for Lydia to get a startup SBA loan than it would be if Lydia were to invest in a dog training franchise. And because that dog training franchise has a proven system. And so if you're a startup franchise business, you have the opportunity to leverage SBA funding compared to if you were a startup independent business. Like, much easier time getting SBA funding as a startup franchise versus a startup independent business. And that's important because then once you're in business, right, you're 9 to 12 to 15 to 18 months in business as a franchise, right? And you started it just with, cash, whatever, HELOC. And then on month 18, you're like, you know what, now I want to get SBA. Even if you're a franchise in that context, chances are you're still ramping up. And even if you're at break even or small profit, at that point in time, the SBA considers you an existing business, and they're going to want to see a couple years of historical cash flow sufficient enough to service the debt. And so there is a use it or lose it dynamic with taking advantage of the SBA as a startup franchise, which is something that's, a thing versus, it's much more difficult as a startup independent business. And it's also, and if you don't take advantage of it startup, then you're most likely going to have to wait 2 or 3 years to get SBA if you don't take advantage of it at startup. So I'm a big SBA guy because it's third-party money that's available to you as a startup franchise, and like taking advantage of the whole use it or lose it dynamic.
How much do people need for an SBA, Michael, typically?
Say it again, Lydia. I'm sorry.
How much do people need for cash on hand for an SBA typically?
Great question. It varies. And so it all depends on how much they are looking. The SBA is looking for cash on hand. They're looking for, does your household have income? What are your assets, et cetera? But most likely you should prepare for a 20% capital injection. And depending on a variety of factors, you might be able to come in with less of a down payment. You might have to come up with more if it's an emerging brand, for example. And so those are factors that are considered when determining how much of an SBA loan you qualify for, and whether or not you're able to qualify for one in the first place, as well as your liquidity, overall assets, and your household income.
So would you say the SBA is the most similar to, the process is the most similar to buying a house? It sounds
Correct.
like. Okay. And then the ROBs, do you need any cash on hand, or are you just able to access those funds? How does that work?
Great question. So like with ROBs, it all just comes down to how much is in your pre-tax retirement accounts. If you have like $5,000 of cash in the bank of just like regular cash, and you have minimal equity in your house, but you have $1 million IRA, then you can just rob in the investment. You're going into like, X, you're going into some brand in some industry, and the total investment in initial plus the first 12 months is $500,000. You can just ROBs $500,000. You can just roll over $500,000 from your IRA to your new Rob C Corp. Done.
Yeah, makes a lot of sense. Now, I've heard the SBA, the rates been going up a little bit. So I've heard HELOCs are a little more popular right now. Can you explain what that is, and how much people need as far as equity in their home to get a HELOC, and all of the above is helpful.
Yeah, absolutely. Um, uh, two umbrella terms that are important to talk about. Maybe we don't talk about, like, so for everyone listening, today's webinar is a general webinar about entity structure and funding strategy. And there are like webinars within each little set, like there are different webinars that can be gone into from all the different topics that we're talking about today. And so when it comes to funding, like one umbrella term is retirement asset funding. ROBS is the most common one, and there are some other retirement asset funding options out there that are worth talking about. And then there's leverage strategy, right? Funding via leverage is an umbrella level topic. And then within that, there's SBA, municipal, county, state, federal loans and grants, conventional loans, HELOCs, unsecured, margin loans. And so, to Lydia's point, HELOC, right? Acronym for home equity line of credit. It's another form of leverage, right? Because you're leveraging the equity in your house. So general rule with home equity line of credit is that the lender is going to do up to 80% of loan to value. Get an appraisal. Some people already have a HELOC, but they haven't tapped into it yet. Some people don't. But get an appraisal on your house. And then whatever and then 80% of that number equals X. Subtract out, what your current, your primary mortgage principal already is. The remaining amount is potential additional HELOC access. And then depending on, are you going to do it with the same lender? They might stack, they might stack it on top, that you might have a lender come in and wants to, refinance and do a cash out refi and the whole thing. But you have to be careful there because the interest rate on your first mortgage might be better than the one on like the new HELOC. So you have, so there's different ways to skin the cat there. And then also, if you're military, there could be 100% loan to value options that USAA or Navy Federal Credit have that most lenders don't. And then also there might be, like, if you have a longstanding relationship with like a local community bank or a local credit union, they might be willing to, I'll put it to you this way. What I'm saying right now are like general guidelines, and then each individual lender out there might have their they have their own rules, and so you might be able to get like a deal that you can't refuse, right? At like a bank that you have like a community bank that you have a long-standing relationship with, compared to a big box bank out there. But general rule, just to bring HELOC in for a landing, 80% loan to value. And that's another leverage. You can leverage the equity in your house to get the liquidity needed to start your business.
Got it. Awesome. And then one of the last ones here is unconventional loans. What are those? Why would someone go that route?
So unconventional loans are, so someone would go that route if it's pretty much the only option that they have for a variety of reasons. The positive of them is that they're quick and easy. They really just look at, some bank statements from the last couple of months just to see if you have some sort of cash flow, and they don't really, go through an intrusive underwriting process like a HELOC might. And so a lot of them are unsecured. And so with that being said, they're going to charge expensive interest, they're going to charge high interest rates. And, I see people going unconventional a lot of the times if they have no other choice and if they're really bullish on the brand that they're going to go into. I also see it if people are using it as a bridge, right? Like they're expecting some money from a house sale in 3 months or an inheritance in 6 months, and they really want to do this business now because they don't want someone to come in and take their territory. And so using an unconventional, unsecured loan as a bridge to get, the cheaper money, so to speak, in 3 to 6 months. And I would just be careful with with unconventional unsecured loans because they present them. I see a lot of lenders, funding companies that present them as an option. They make the interest rate seem like similar to an SBA loan. But then where they get you is on like the origination fees up front. Like they might charge like a 15% of the total loan like at closing, right? Which is crazy. And so just be like my whole thing with unsecured, unconventional is just be careful and just make sure that you read all the fine print on them, any prepayment penalties and stuff like that. And so since we're on the topic of leverage, just like something that I think is really worth mentioning is margin loans. So if you have a non-retirement stock portfolio, and let's just say that it's $500,000, non-retirement stock portfolio, and you want to access that money, if you want to access that money, for the either for your entire business or for the down payment on an SBA loan, and the SBA will do the rest of the investment. If you were to just take the money out as a distribution then there would most likely be a capital gain hit, right? There would be a taxable event. Whereas with the margin loan, it is most lenders would be able to most financial institutions where your non-retirement stock portfolio is held would be able to provide a margin loan up to 50% of the portfolio value, and the interest rates are similar to HELOC, and potentially could be a little less. And a streamlined underwriting process, because all the financial institution does is collateralize the portfolio. They don't really care so much about other factors like a HELOC underwriting process would. And so a margin loan is a way to leverage your stock portfolio for a capital injection into your business without incurring a capital gain event. So that's another big one that I like to bring up to people when, again, right, whoever I talk to, I get context on their investment, their assets, and their income, their household income. And if I see an opportunity, if I see non-retirement stock portfolio there, I like to mention margin loan as an option.
Got it. No, that makes a lot of sense. So all of these options, I guess, one to go back to, because we didn't cover it, ROBS, do people have to pay interest on the money that they take out from their own retirement account, or is it really just the tax hit?
Great question. So, there are times when people do a ROBS and SBA. So
Okay.
if someone's doing a ROBS and SBA, like it'll be a C corp and it would have an SBA loan, and so there would be interest on the SBA loan. But in this hypothetical, if someone were to just do a ROBS for the whole thing with no debt, then there wouldn't be any interest. And then there would and then all of the money, not to get into the weeds too much, but there wouldn't be any interest. But a difference between a C corp, a Rob C corp, and let's say an LLC taxed as an S corporation is that if you were to take $100,000 out of the Robs, no debt, right? But you take $100,000 out as a salary, then that salary would be subject to income tax, federal and state, depending on what state you're in, plus a full 15.3% self-employment tax, also known as Social Security Medicare tax. $100,000 of S corp, even if there's debt, like if there, in this hypothetical S corp with a SBA, let's say for example, there could be interest, right? But then the 100,000 coming out could be a portion salary, portion S corp distribution, and the distribution piece could be exempt from the 15.3% Social Security Medicare tax. So, doing the feasibility analysis on those two things is always an important thing. If you as the franchise buyer are debating between ROBS with no debt or LLC taxes S corp with a leverage strategy, which one makes more sense when zooming out and taking into consideration all the different costs, which are primarily interest expense and taxes, both income taxes and self-employment taxes, AKA Social Security Medicare taxes. These are all costs, right? And so just seeing which one makes the most sense. And then again, another conversation for another day, unless we want to go into it now, which I'm happy to, is flow through taxation, right? Flow through taxation, if you're an LLC, taxed as a sole prop, S corp, or partnership, and how that works. That's worth going into as well.
Yeah, we can save that for another webinar. Michael, that's great. No, that's very, very helpful. So thank you. All right, let's go to the next slide. Here we go. Strategic tax planning. Let's talk a little bit about that.
Absolutely. So a big thing there, looking at the slide, top left, bonus depreciation in section 179. So again, if you're listening to this webinar that Lydia and Eric and I are recording, it's August of 2025. And so that means that the big, beautiful bill passed about, 6 weeks ago. So we're really fresh in it. And a big proponent of the tax legislation in the big, beautiful bill is now bonus depreciation is back to 100% of qualifying fixed assets effective January 2025. So, this is a huge, it's a very pro business owner, like if, the tax code is written for the self-employed, the big, beautiful bill just made it that much more, written for the self-employed. The difference, so there's two types of accelerated depreciation on fixed assets, fixed assets, machinery, equipment, furniture, fixtures, qualifying leasehold improvements, and vehicles to a certain limit. And again, not to rabbit hole into, because there are some nuances and everything that I just said right there, but high level, there's two types of accelerated depreciation. There's bonus depreciation and section 179 depreciation. And if you are listening to this webinar right now and you're thinking about buying a business, chances are this business is going to be the only self-employed thing that you have on your tax return. It might not, right? Because there are people out there that are, entrepreneurs, have businesses, etc. Spouse has a business. But the key difference is bonus depreciation, and I'm talking federal here because all states have their own little nuances for, allowing, disallowing bonus depreciation and section 179. But bonus depreciation, if you are already at a break even or a negative, and it's expected, by the way, that you're going to have a startup tax loss for your startup business, right? You have to crawl before you walk, walk before you run before you sprint type of thing, right? Like if you start a business, you're going to start out at a loss, especially if you're in a new territory. It's normal, right? And you're going to have a loss due to the fact that you're ramping up revenue from zero and startup expenses, especially the accelerated depreciation of fixed assets. Now, if you have fixed assets that qualify for bonus depreciation and you're already at a break even or a negative, then the bonus depreciation is going to further the negative. It's going to increase the loss even more. And so that means that you'll be able to, like if you and or your spouse have W-2 income, taxable retirement income, taxable rental, taxable portfolio income, et cetera, already on your personal tax return, then that bonus depreciation is going to increase the startup loss, thus resulting in you having less taxable income on your personal return, thus owing less money in taxes or getting a bigger refund. Whereas Section 179, accelerated depreciation, allows you to write off the entire asset in the year of incurrence, like bonus. Again, there are some high limitations, but only to the extent of profit or to the extent of other self-employed non-passive income on the personal tax return. So with Section 179, if you were to elect Section 179 in the same hypothetical, there's a chance that if you're already at a break even or a loss, and then you Section 179 the fixed asset, it's not going to further increase the loss, and it's going to roll forward to the next year as a Section 179 carry forward. Therefore, for startup businesses, bonus depreciation is more beneficial for the reason mentioned than Section 179. And so zooming out, how tax strategy influences funding decisions. All of these things are, things that we talk about on the free CPA consultation calls. These are things that even if it's just, 2 to 4 conversations a year with your CPA, in addition to the normal January through April grind of filing last year's taxes, you want to make sure that you have at least 2 to 4, if not more, at least 2 to 4 touch points throughout the year with your CPA, checking the pulse on things such as, accelerated depreciation like bonus in Section 179 depreciation, right? Interest expense, the effects on taxable income, right? Interest is a cost, but every dollar, this is an example of good debt, interest on business loans, right? Every dollar, every dollar of interest expense is a tax write-off, right? So for, you may be paying hypothetically $10,000 to $15,000 in interest expense on a loan, but that's saving, for every dollar in interest expense, you're saving 30 cents in taxes, high level, right? So that the tax savings of interest expense needs to be taken into consideration when you're determining which way to fund your business. An SBA loan, a conventional bank loan, et cetera, et cetera. Now, robs, right? Again, if you robs the whole thing, no interest, but then like all the money that you take out for personal use is subject to payroll taxes. So the feasibility analysis of that has to be taken into consideration. Leveraging W-2 income. And so that I touched on that. I touched on that on the depreciation topic, right? Startup losses. Now this one is about, in order for this to be a thing, you would have to have a flow-through structure, right? So an LLC taxed either as a sole proprietorship or a partnership or an S corporation. What those three tax classifications have in common are they are all known as flow-through entities. So the bottom line, right, the profit or loss flows through to and gets reported on the personal tax return of the individual, whereas a C corp, it stays in the C corp and it rolls forward. And so if you have a startup loss, then you could leverage that startup business loss for your startup franchise in a flow-through entity and have it flow through to your personal return where it can offset W-2 income and help you save money in taxes on your personal income tax return.
Yeah. A lot of great options when you own a business, that's for sure. Okay, so entity structures. There's a couple different options that we can talk about. So I'll go ahead and let you take it from here then, Michael.
Yeah, absolutely. So with an LLC, it's important to know that an LLC is a legal structure at the Secretary of State level for your respective state. An LLC is a hybrid entity when it comes to being to taxes. So an LLC with one owner by default is taxed as a sole proprietorship. An LLC with two owners by default, with two or more owners by default is taxed as a partnership. At any time, either at inception or subsequently, the same LLC can elect to be taxed as an S corporation or a non-ROBS C corporation. And so that's one of the big reasons why I'm a big LLC guy is because of the flexibility that it gives for tax classification. S corp is you could either be an LLC taxed as an S corp or you can be a regular corporation that elects S corp treatment. The primary so the one bullet here, it says, pass through taxation, yes. Reducing personal tax burden, yes. But what it really is it reduces self-employment tax burden. So if you're coming out of corporate, if you were if you were a W-2 employee either in the corporate, government, or nonprofit world, you would have Social Security and Medicare taxes taken out of your paycheck. When you're self-employed, on your self-employed income, when it's positive, you have the burden of both the employee portion, which you would normally see in your paycheck when you're working in corporate, and the employer portion. And so self-employment tax is another term for Social Security and Medicare tax. And it's 15.3% of self-employed earnings up until certain limitations. And you go as like the primary tax saving benefit, the primary year-over-year tax savings benefit of being an S corp is one, it only makes sense. It only makes sense once you're profitable. If you're showing a loss, that you're not benefiting from being an S corp compared to a sole prop or partnership, for example. But the primary tax savings and year-over-year tax savings for an S corp is saving money in self-employment taxes, also known as Social Security and Medicare taxes. That's the big thing for S corp tax classification. And then C corp. So in this context here, C corp. The most important thing for all of y'all listening today on C corp is that if you go ROBS, you have to be a C corp. and just understanding what a C Corp means from income tax compliance and ERISA compliance as a Rob C corporation, and everything, we like a lot of the stuff that we hashed out today on today's webinar and specific for Robs, like that's the main thing that you have to be aware of for a C Corp. Because if you're listening to this webinar, if you're going C Corp, you're most likely going C Corp because you're going the Robs route. There are other ways, like if you plan on having outside investors, like there are times, right? And like if you're working with like Lydia or Eric, and it's determined that you're a empire builder, right? If you're someone who wants to invest in a franchise and then be a multi-unit operator and like sell to private equity for 5 to 7 years, hypothetically, like in that case, being a regular C Corp, a regular non-Rob C Corp, and qualifying for this thing called QSBS, Qualified Small Business Stock, like that could make a lot of sense in your situation because you're going into this thing on day one of year one, either by yourself or with investors, and you're looking to build super fast and have an exit in 5 to 7 years. Then the only reason why you would want to do that as a non-Rob C Corp is so you can do a stock sale at exit, and the majority, if not all of the capital gain, would be exempt from capital gains tax. Like that's an example of why you would want to be a C Corp when it's got nothing to do with the Rob structure. And some of y'all that applies to, but a lot of people out there go into business ownership for lifestyle, which is amazing, which is like I'm just forever. I'm over here in Eastern Europe right now, and I'm working, but I can work from wherever because I'm my own boss, and that's pretty sweet. And so like when people, yes, the tax code is written for the self-employed. Yes, earning potential, is more in your control when you're self-employed. But like for me personally, like what's the biggest reason why I'm self-employed? Lifestyle. Like autonomy of schedule. And so, for most people that are in for lifestyle, if you're not doing Robs, then, there's a good chance that, you're going to be an LLC tax as a flow through. If you're going to go C Corp, it's going to be in the context of Robs. And for you empire builders out there, a non-Rob C Corp that qualifies for QSBS, could be a thing. And then there's some creative things that we can do with like doing that, plus setting up like a side S Corp management company so you can kind of have your cake and eat it too. But as you guys can tell, the espresso is flowing and I'm passionate about these topics, and we don't have 3 hours, so I'll control myself.
Yeah. So I guess one question on the entity structure, Michael, and one thing I think it would be important for people to understand is you can always start as an LLC and then later you can become an S Corp or a C Corp and do that at any time. Is that correct?
That's correct. And that's an important thing. Like an important case study there is if you're going to, let's say you're going to do an LLC with an SBA loan. Okay. And it's going to be a brick and mortar. So you're going to have a lot of like qualifying, depreciation because you're going to have fixed assets and build out. And you have a lot of W-2 income on the personal return, you and or spouse. In that, like if you have this big startup loss and it's majority funded by third-party debt like SBA, that's in that hypothetical, you want to start you don't want to prematurely elect S Corp too soon. Because now, okay, getting into the weeds a little bit, you're going to run into what's known as a basis issue. And if you're a multi-member LLC, default tax is partnership, then third-party debt counts as your partner's basis, which means that you can have a big loss due to the combination of startup and accelerated depreciation of fixed assets, but it was majority funded by third-party SBA loan, and you have this loss. In a partnership and in a partnership tax classification, chances are that entire loss is going to be deductible. Whereas in that same situation, if you elected S Corp right out the gate for that same entity, and now it's an S Corp with a big loss, majority funded by SBA loan, third-party debt is not part of stock or loan basis in an S Corp, and so now you run the risk in that hypothetical of having the majority of the loss, suspended because of basis limitations. And so to bring it back to Lydia's point, that one of the beauties on an LLC is you can start out as a multi-member LLC taxed as a partnership. And in that, during startup, exhaust all the tax benefits of the startup loss, not run into any basis issue, right? And then year 2, year 3, you ramp up and you're profitable. Then you take that same LLC, which you've already gotten all the tax benefits at startup from the business loss because you were a partnership LLC, you didn't have a basis issue, all the tax savings there wiped out your and your spouse's W-2 income, you get all this money back on your 1040, right? And then in like year 3, now your business is profitable, and then boom, same LLC, you elect S Corp. You've already resigned from your job, right? You've already resigned from your job because you're profitable over here. So your Social Security wage base starts at 0. And so now you go S Corp, and then you can be saving potentially $10,000 a year in self-employment taxes just by being taxed as an S Corp compared to a partnership. So my long-winded way of saying absolutely, Lydia, correct. And that's, and that's like a classic example of what I detailed of why an LLC is great. You start out as a partnership at startup strategically, and then you strategically elect for it to be S Corp, not immediately, but in year 2 or 3.
Absolutely. Makes sense. All right. I think that's pretty much everything that we wanted to cover today. So I hope this was helpful. If you do have any questions, please reach out. If you have questions about franchise ownership or you're just curious, you want to learn more, please connect with either myself or Eric anytime. Again, our service is at no cost to you, and we're happy to have a call, no pressure. Or if you have questions about funding options and you want to learn more first with Michael, please reach out to him too. So thank you.